Washington, D.C., September 17, 2025. The United States Federal Reserve has delivered its first interest rate cut since President Donald Trump began his second term in office. But the scale of the cut has fallen far short of what the White House had been pushing for. For months, Trump had publicly and privately pressured the central bank to slash rates by 3 full percentage points, a demand rooted in his belief that cheaper credit would supercharge investment, construction, and above all, the real estate market. Instead, the Fed's decision was measured, a modest 0.25 percentage point cut, lowering the benchmark rate to a range of 4.0 to 4.25%. Federal Reserve Chair Jerome Powell, announcing the move in Washington, underlined the independence of the central bank in unusually pointed terms. Powell said, "We remain firmly committed to preserving our independence." His words were directed not only at financial markets, but unmistakably at the White House. The cut comes after a sustained campaign by President Trump to bend the Fed to his political and economic agenda. From campaign rallies to Oval Office remarks, Trump has repeatedly accused Powell and his colleagues of holding back America's growth by keeping borrowing costs high. Trump's argument has been clear: cheap loans fuel housing construction, commercial real estate, and consumer spending, all vital for both the broader economy and the president's own political narrative of prosperity. As a businessman whose fortune is tied to properties and brand licensing, his focus on mortgages and development projects carries personal as well as national undertones. White House aides confirmed in background briefings that Trump directly raised the issue with Powell during several encounters earlier this summer. Cameras captured the president alongside Powell and Senator Tim Scott on a tour of the Federal Reserve headquarters in late July. The optics made headlines, a president leaning over central bankers, visibly animated, pressing his case for sweeping cuts. For many observers, this represented an unprecedented blurring of the line between the executive branch and a central bank that has historically guarded its independence fiercely. The Federal Reserve's leadership has resisted Trump's calls for drastic cuts, citing risks of inflation, financial instability, and long-term credibility. Officials argued that slashing rates too aggressively could send the wrong message to global investors, that U.S. monetary policy had become an extension of partisan politics. Still, Powell conceded that circumstances had changed. The central bank now sees uncertainties clouding the outlook, not least those linked to the president's own aggressive tariff policies. Trade disputes have slowed exports, dented corporate investment, and created volatility in manufacturing. Most crucially, Powell pointed to a weakening labour market as the tipping factor. Powell said the cut was driven by the deteriorating labour market situation. Unemployment figures, while still low by historical standards, have edged upward in recent months. Job creation has slowed sharply and wage growth is flattening out. For the Fed, that was the signal that some relief was warranted. This balancing act between responding to economic conditions and resisting political pressure has defined Powell's tenure. Each move by the Fed is scrutinized for signs of capitulation to Trump, or conversely, defiance that could trigger retaliation from the White House. The president has openly mused about replacing Powell and other senior Fed officials with figures more aligned to his agenda. Allies in Congress have floated legislative proposals that would bring the central bank under greater executive oversight. Economists warn that such moves could undermine the credibility of U.S. monetary policy, destabilize financial markets, and weaken the dollar's role as the world's reserve currency. Against this backdrop, Powell's insistence on independence carried extra weight. His line, "We remain firmly committed to preserving our independence," was seen as a direct rebuttal to Trump's pressure. At a press availability shortly after the announcement, Trump did not conceal his dissatisfaction. He reiterated his belief that only a dramatic cut could unlock the true potential of the American economy. His comments reflected both his political strategy, portraying himself as the champion of growth, and his personal frustration with a central bank that continues to defy him. The president's allies, particularly within the real estate and construction sectors, echoed his sentiment. Developers argue that high borrowing costs are stifling new projects. Mortgage brokers say potential home buyers remain hesitant as rates hover above historic lows. For them, Trump's call for 3 points off was not just political theatre, but a policy they genuinely desired. The Fed's decision resonates far beyond US borders. International markets had braced for a potential signal of political capture of the central bank. A drastic cut would have rattled confidence in US institutions and potentially devalued the dollar. Instead, the modest move reassured many that the Fed remains cautious and deliberate. Global investors reacted with a mixture of relief and skepticism. Equity markets ticked upward on hopes that lower rates would sustain corporate earnings. Bond markets, however, priced in expectations of further cuts if economic indicators continue to worsen. The dollar weakened slightly, reflecting both the lower yield outlook and persistent concerns about US trade policies. A key element shaping the Fed's decision has been Trump's tariff regime. Over the past 2 years, the administration has escalated trade disputes with China, the European Union, and smaller partners. Tariffs on steel, aluminum, electronics, and agricultural goods have disrupted supply chains, raised costs for businesses, and strained international relations. Economists inside and outside the Fed have warned that this trade uncertainty acts as a brake on investment. Companies hesitate to expand or hire when they cannot predict whether a new tariff might hit their inputs or exports. This hesitation, they argue, has contributed to the weakening labour market that Powell cited. Thus, in a twist of irony, the very policies Trump champions are the same uncertainties, forcing the central bank to provide modest stimulus. This episode recalls earlier clashes between US presidents and the Fed. Lyndon Johnson reportedly bullied then-Chairman William McChesney Martin over Vietnam War spending. Richard Nixon pressured Arthur Burns to keep rates low ahead of his re-election campaign. Both episodes are now remembered as cautionary tales of political interference leading to runaway inflation. Powell's defiance, therefore, situates him in a long tradition of central bankers resisting presidential pressure. Yet never before has the confrontation played out so publicly, amplified by Trump's penchant for social media attacks and his willingness to personalize disputes. On the day of the announcement, cameras captured Powell walking into the marble-lined press briefing room at the Federal Reserve headquarters in Washington. The US and Federal Reserve flags fluttered atop the building, the carved eagle emblem casting its long shadow above the entrance. Reporters crowded the hall, eager for any hint of whether the Fed had bent to Trump's demands. Powell, typically reserved, struck a firm tone. He explained the rationale for the modest cut, reiterated the Fed's dual mandate of price stability and maximum employment, and dismissed speculation that politics had guided the decision. On the streets of Los Angeles and Baltimore, reactions reflected the broader divide. In shopping malls, some welcomed even a small cut, hoping it might ease credit card interest or auto loan rates. At the Port of Baltimore, business leaders pointed to containers piled high, warning that trade tensions were choking exports and imports alike. Among ordinary homeowners, the impact may be less immediate. Mortgage rates had already drifted downward in anticipation of a cut, but a quarter-point move will not transform affordability overnight. Still, for a market long accustomed to historically low rates, even incremental easing is seen as a step in the right direction. Looking forward, the key question is whether this is the start of a series of cuts or a one-off adjustment. Analysts are divided. Some believe the Fed will be forced to cut further if unemployment rises or if trade wars escalate. Others argue that the central bank will hold firm unless clear signs of recession emerge. Trump, however, is unlikely to relent. His demand for 3 points off remains a political rallying cry. As the 2026 midterms approach, he is expected to frame the Fed as an obstacle to growth and himself as the relentless advocate of American prosperity. The Fed, meanwhile, faces a delicate balancing act, providing enough support to keep the economy stable while defending its institutional independence from political incursions. The modest 0.25 percentage point cut, though significant in signaling a shift, falls well short of the White House's ambitions. It underscores the growing tension between an administration eager for short-term economic boosts and a central bank wary of undermining long-term stability. At the heart of this drama are two men, a president who thrives on confrontation and a central banker determined to protect the integrity of his institution. Their clash will shape not only the trajectory of US interest rates, but also the credibility of one of the world's most important financial institutions. And so the story continues. Is the US economy suspended between politics and policy, spectacle and substance, demands and discipline?